Have you ever wondered how someone can afford to buy $1 million car without totally draining their bank account? Most of us are taught a very simple formula. You work hard, save up your money, and then hand it over to buy the things you want. But wealthy people treat their money differently. Instead of trading their savings directly for a car, they buy an asset, like a rental property or a business, that produces a steady stream of cash. They let the profits from that asset pay for the car. It sits in the driveway, and they still own the asset that bought it. It's a concept that financial author Robert Kiyosaki talks about quite a bit. The shift happens when you stop working for your money, and you start making your money work for you. When you see that luxury car, you're looking at the leftover profits from a system designed to keep the original cash safe and growing. Now, you might be thinking the first step to building that system is just to save as much cash as possible. But traditional saving has a hidden leak called inflation. Every year, the cost of groceries, housing, and gas slowly goes up. If your money is just sitting in a regular bank account, it loses a little bit of its purchasing power every single day. Think of a dollar like an apple seed. Saving it is like putting that seed in a glass jar. It feels safe, but it's dormant. Over time, it shrivels. Investing is when you take it out of the jar and bury it in the dirt. Out in the open soil, that seed is exposed to droughts and storms. There is real weather-related risk involved. But the soil is also the only place where that seed actually has the mathematical possibility of putting down roots and sprouting into something bigger. Keeping your money completely safe actually guarantees it will slowly lose its value. To outpace inflation, you have to be willing to expose your money to calculated risk over a long period of time. Once your money is planted and starts growing, it triggers a powerful mathematical chain reaction known as compound interest. This is what happens when the money your investment earns starts earning its own money. This diagram shows how that works in our garden. Your first seed grows into a mature tree. Eventually, that tree drops its own apples. Those apples contain new seeds, which bury themselves in the soil and grow into new trees. Give it enough seasons, and a single seed has turned into a self-sustaining orchard. A lot of people assume you need a massive pile of seeds to get an orchard like this started, but you really don't. This diagram shows a method called a SIP, or Systematic Investment Plan. It is the financial equivalent of an automated sprinkler system for your portfolio. Instead of waiting for a huge sum, a SIP automatically invests a small, fixed amount monthly. It pulses steady water on an exact schedule, ignoring the daily forecast. Sunny or storming, the sprinkler works. Because those small contributions keep adding up month after month, year after year, your consistency and your patience end up being far more powerful than the amount of money you started with. When you decide to start planting, you have a few different options for your seeds. The first is buying individual stocks. This means you are personally picking out one specific company and planting that single seed in your yard. If that specific company grows into a massive tech giant, you do incredibly well. But if the company struggles, if your plant gets sick, you could lose everything you put into it. You carry all the risk. This animation shows a different approach, a mutual fund. Instead of going it alone, you pool your money together with thousands of neighbors to hire a professional gardener. They take that pool of cash and plant a diverse mix of crops. Then there is an ETF, or exchange-traded fund. Think of this animation as a pre-packaged garden bed. You don't need a professional gardener to pick the seeds for you. It automatically includes a tiny slice of hundreds of different companies to match the overall market. You can buy and sell an ETF instantly, just like an individual stock. But because it holds so many different seeds at once, it gives you the built-in safety of a mutual fund. Whether you choose individual stocks, a mutual fund, or an ETF comes down to how much time you want to spend tending your garden and how comfortable you are with the possibility of losing a crop. Many beginners confuse investing with short-term trading. Trading is the attempt to guess exactly when the market will go up or down, trying to buy at the absolute lowest moment and sell a few hours or days later. It is incredibly stressful and very difficult to get right. To go back to our garden, trading is like planting a seed on Monday and then digging it up every single morning to check if the roots have grown yet. You end up disturbing the very process that creates the growth. It also tempts people into following the herd. When everyone on social media is buzzing about a hot new stock, beginners rush in to buy it. They are buying the hype, not the actual value of the underlying business, which usually means they are buying right before the price drops. Real investing requires you to act entirely differently. You set up your water supply, make sure the soil is good, and then you walk away for a decade. The investor Warren Buffett is famous for ignoring daily price swings. In fact, he likes to say that his favorite holding period for a good asset is forever. Building a fortune has very little to do with predicting the future. It's mostly about having the patience to sit still and the discipline to ignore everyone else's panic. Let's look at how to put this into practice. Rule number 1 is to establish a clear financial goal before you spend a dime. You need to know if you are planting a small vegetable patch for next summer or a giant oak tree for your retirement. Rule number 2, diversify your portfolio. Spread your seeds out across different types of crops so that if a sudden frost kills one off, the rest of your garden survives and protects your original cash. Rules 3 and 4 go hand in hand. Stop trying to time the market highs and lows and set up an automated SIP to invest a little bit every month, no matter what the news is saying. Rule number 5 is simply to step back. Give compound interest the years it needs to multiply your money until it's doing the heavy lifting for you. You do not need to be a millionaire or a financial expert to start building this kind of system, but the math of compound interest demands time, which means you do need to plant that first seed today.